As many of you know, I live in Singapore, which is ranked the most expensive city in the world for 9 years in a row. In Singapore, the cheapest Toyota car that you can buy is $200,000. But although I live in Singapore, many of you would know that the majority of my wealth is invested in the US markets. So many people ask me, why do you primarily invest in the US markets and not in the Singapore market? So in this video, I'll do a side-by-side comparison between the US markets and the Singapore markets. So one of the main reasons I primarily invest in the US markets is because obviously it gives the highest returns, so my wealth compounds at a much higher rate. So to represent the US market, we are looking at the S&P 500 over here. And to represent the Singapore market, we are looking at the Straits Times Index. So for example, if you take a look at the 1 year, 5 year, 10 year, 20 year time frame, the US market way outperforms the Singapore stock market. So for example, in the last 1 year, if I click 1 year over here, you can see that the US market, based on the S&P 500, gained 21.7%, whereas the Singapore Straits Times Index lost 7% in the last 1 year. But that's just 1 year. How about a longer time period? Let's look at 5 years. Over the last 5 years, the S&P 500 gained 86% versus the Singapore market that lost 1% even after 5 years. Now, what about going further back 10 years? Okay, so let's drag it 10 years, which would be about early 2014 to where we are today. Okay, so over the last 10 years, the US markets gained 167%, whereas the Singapore markets gain 0.59%. So you can see that in terms of capital gain, compounding your wealth, investing in the US markets gives much higher gains than the local Singapore market. Now, some would ask, but how about currency, right? Because if you convert your Singapore dollars to US dollars, what if US dollars depreciate against the Singapore dollars? Now, what's great about this charting software TradingView is that you can adjust for currency. So right now you can see the US market, the returns are based in US dollars, whereas the Singapore market is based in Singapore dollars. So if I want to do a proper comparison, I have to compare them both in the same currency. So I'm going to click from mixed to let's shift it to comparing both in terms of Singapore dollars. And there you go. So even if you adjust for currency, you can see that the US market gains 182% even after factoring for currency change from Singapore dollars to Singapore dollars, right? Whereas the Straits Times Index up just about 0.59%. Now, of course, bear in mind that this 182% return in the US market assumes that you invest in the S&P 500, which are the 500 biggest companies in the US market. Now, I don't do that. As you guys know, I only invest in the top 1% of US companies that way outperform the S&P 500. Because remember that within the S&P 500, there are good companies, bad companies, super companies, lousy companies. So if you pick the best companies, for example, like Microsoft or Apple or Nvidia or Google, then of course you get much higher than 182% over the 10-year period, right? So simply, if you just put in, for example, Microsoft, which is one of the biggest stocks in my portfolio, you can see Microsoft during this period, whoa, look at that. It increased 1,237%, versus the S&P 183% versus the Straits Times Index, which is not even 1%. So when you buy a high quality US stock, it makes the Singapore index and the US index look like fixed deposit. So that's why it's really important as an investor, you have to learn the skills of how to pick the top 1% of stocks in the market. These are the kind of companies that I invest in, companies that have wide economic moat, sustainable competitive advantages, that have got high return on capital, that have got consistent growth in revenue, profits, and free cash flow with low debt and so on and so forth, right? Now, the second reason I prefer to invest primarily in the US market is because it is less risky and less volatile than the local Singapore markets. Now, when I teach students in Singapore to invest in the US markets, you would think, but isn't the US market more risky, it's more volatile? Well, let me show you the facts. let's start with the S&P 500. Now, we have got 73 years of data for the S&P 500, and you can see that, for example, this year, 1951, it was up 23%. 1952, it was up 18%. 1953 was down 1%. So the market goes up, down, right? It goes up and down. But if you take a look at the table, you can see that over the long run, there are more up years than down years. And in the last 73 years, if you count, they were altogether 16 years the US market went down or ended down on a given year. So 16 out of 73 is 22%. And 57 years out of 73 years ended with a gain that's 78%. So in other words, when you invest in the US market in any given year, your probability of ending with a gain is 78%. That's pretty good, right? Now, what if you hold for a longer period? What if you hold for a 5-year period? So if you take a look at the next chart, these are all the different 5-year periods. So over the last 73 years, there were 69 5-year periods. For example, 1951 to 1955, 1952 to 1956, 53 to 57. So these are every single 5-year combinations. So if we take a look at all the 5-year combinations, there are altogether 69 of them. How many 5-year periods ended with a loss? 1, 2, 3, 4, 5, 6. 6 out of 69. That's 8%, 8.7%. And 63 of those periods ended with a gain out of 69, which is 91%. So you can see that in the US market, if you hold for 1 year, your chance of making money is 78%. If you hold for 5 years, your chance of making money is 91%. What if you hold for 10 years? Well, these are all the different 10-year combinations, right? 1951 to 1960, 1952 to 61. So it's every single 10-year combination. And how many of these 10-year periods ended with a loss? 2, right? 1999 to 2008 and the year 2000 to 2009. Those two 10-year periods ended with a loss, right? Out of 64, 2 ended with a loss. So that's 3.2% probability. Whereas 96% of the time, if you hold for 10 years, you end with a gain. Now, let's compare it to the Singapore Straits Times Index. Now, the Singapore stock market is not as old as the US market, so we don't have 73 years of data. So the furthest back I can get is 36 years of data. So if we take a look again in the Singapore market, you can see some years they go up, some years they go down. Now, out of 36 years, how many years ended with a loss? You can see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. 16 out of 36 years ended negative for the Singapore market. So that's 44% of the time. And 20 out of 36 years ended with a gain. That's 55% of the time. So again, which is more risky? US market or Singapore market? Well, to me, Singapore market's more risky because there's only a 55% chance I will get a gain after 1 year. Whereas in the US market, it's a 78% chance of getting a gain. Now, what if I hold Singapore stocks for 5 years? Well, they're altogether 34 5-year periods, right? 1988 to 1992, 89 to 93, and so on and so forth. And out of all these 5-year periods, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 ended with a loss. That's 44% of the time. And 19 out of 34 ended with a gain. That's 55% of the time. So if I hold for 5 years, my chance of making money, it's still 55%. Well, maybe 56%, right? But if I hold for 10 years, okay, then the probability looks a bit better, yeah? So out of all the 10-year periods, there are 27 10-year periods. 1, 2, 3, 4, 5, 6 ended with a loss. That's 22% of the time. So if I hold Singapore stocks for 10 years, then I have a 77% chance of making money after 10 years. So again, direct comparison, I feel the US market has a higher probability of making money in a 1 year, 5 year, and 10 year time frame. The next question to ask is why? Why is the US market giving much higher returns with less risk and less volatility than the Singapore market? It all boils down to the component companies that make up the index. So let's drill down to better understand why. Let's begin with the S&P 500. Now again, the S&P 500 is made up of the 500 biggest companies in the US. And it's what we call a market-weighted index, which means that certain stocks that are bigger have a bigger weight in the index, right? So these are the 500 companies right in front of you. And which companies have the biggest weight in the index? Microsoft, Nvidia, Apple, Broadcom, Google, Meta, Amazon, Tesla, and the rest are a bit small, right? So first off, what do you notice? You notice that the biggest companies that move the US index are technology companies. And these are tech companies that are in secular, which means long-term growth trends, which means whether, recession or no recession, pandemic or no pandemic, these companies continue to grow because everyone in the world uses Google. We can't live without Google. We search on Google every day, Google Maps, Google Docs, Google Calendar, right? We can't, many of us, well, me at least, I can't live without Apple. Everyone in the world uses Apple. iPhone and iCloud and MacBooks, stuff like that. Everyone in the world uses Microsoft. I can't live without Microsoft. Amazon, many people in the world can't live without Amazon. Every day I'm on Facebook, I'm on Instagram, can't live without Meta. So primarily it's driven by companies that everyone in the world uses. So there's very high growth as well as very high return on capital and very, very high profit margins. And if you take a look at the sector weightage of the S&P 500, you can see that about 1/3 of the index is made up of technology companies. And again, tech companies have the highest growth and highest profit margins. Second biggest weightage would be financial companies, and very close would be healthcare companies and consumer discretionary. Okay, so that's the kind of like the makeup of the US market. So one thing to understand is that when you look at different sectors, you have got what we call very cyclical sectors. Cyclical sectors are companies that make money when the economy is doing well, but they lose money or make less when the economy is not doing well. It's very cyclical. So they make money, they lose money, they make money, right? And so the share price is very volatile. So what kind of sectors are cyclical sectors? Real estate is very cyclical, right? Industrial sector, very cyclical. Energy, oil and gas, very cyclical. Commodities, also known as materials, very cyclical. These are very cyclical sectors. So if you take a look at the US index, notice that the very cyclical sectors like materials, commodities, real estate, energy, and industrials, they are very cyclical, but they make up a small weight of the index. Now, what's the opposite of cyclical? Defensive. So defensive stocks are companies where they don't grow a lot, right? But they grow very slow and steady. They are very defensive, so they are quite recession-proof. And these are the healthcare, the consumer staples, and the utilities. These are the defensive sectors, right? And you can see in the US market, healthcare makes up at least a double-digit weight, plus consumer staples, plus utilities. So we have got cyclical stocks, we've got low-growth defensive stocks. The third category is my favorite. And these are what we call the secular growth sectors. These are the stocks that have very high growth. And basically, there are only two sectors that do this: technology and consumer discretionary. So I repeat, technology and consumer discretionary have the highest growth. So technology would be, again, Microsoft, Nvidia, Apple, Salesforce, Service. These are the tech companies, right? What are consumer discretionary? These are branded goods. For example, in Europe, you've got LVMH, you have got Ferrari. In the US, you got Tesla, you have got Lululemon, you got Nike, you got Amazon, you got Mercado Libre. These are branded goods, branded products, and so they've got high profit margins and high growth. And you can see in the US market, 29.8% plus 10%, which is total 40%, close to 40% of the US market are driven by high growth sectors. On the other hand, let's take a look at the components of the Singapore Straits Times Index. So these are the 30 companies in the Straits Times Index. You have got ComfortDelGro, Jardine Cycle and Carriage, DBS, Venture Corp, City Development, and so on and so forth, right? And if you look at the sector breakdown of the Singapore Index, you'll notice that the bulk of the index is made up of financials. Financials make up 40%, of which most of it would be the 3 Singapore banks. And then you have got industrials, 21%, real estate, 17%. So remember, real estate, is it cyclical, defensive, or growth? Yeah, this is cyclical, right? Very cyclical. How about industrials? Industrials are cyclical as well. Okay? How about financials? Financials are also cyclical. Okay? So you can see that in the Singapore market, 40% plus 17 plus 21, that's 40, 50, 60. My God, close to 80% of the Singapore market are in cyclical companies, companies that are very economically sensitive. So in the economic good times, they do very well, but when the economy is not doing well, they do very badly. So you get these very big swings, all right? And in the Singapore market, does it have any growth sectors like technology and consumer discretionary? Only 1%. So that's very little growth, right? Are there any defensive stocks? Again, defensive would either be consumer defensive, all right, or could be consumer discretionary, and that's 9%, of which most of it actually is consumer discretionary. So there's not much defensiveness as well. So am I saying that there's no point investing in the Singapore stock market? I'm not saying that. In fact, the Singapore stock market has one advantage that the US market doesn't have. And that is, in general, Singapore stocks, not all of them, but some of the good Singapore stocks pay much better dividends than US stocks. That's one advantage. And Singapore stocks, the dividends are tax-free. Whereas if you buy US stocks for dividends, there's a 30% withholding tax. But if as a Singaporean, both the US market and Singapore market, there's zero capital gains tax. That means you're not taxed on the price appreciation. So it really depends on your objectives. I feel that if your objective is to get capital gain, price appreciation, sure, the US market wins the Singapore market. But if you just want to get dividends, you're not interested in the price appreciation, you just want to get good dividends, then Singapore stocks do give better dividend yield. Not all of them, but the better companies. So for example, if you look at most US stocks, right now, even with high interest rates, the dividend yield of good quality companies would be about 3% at the very most, 3% dividend yield. But for high quality Singapore stocks like DBS, UOB, Ascenders REIT, they are giving 5-6% dividend yield tax-free. All right. So in fact, I also have a dividend portfolio that consists of Singapore listed stocks, mainly the banks and the high quality REITs. And for my dividend portfolio, I'm not interested in getting price appreciation because I know it's very, very low, but I'm just getting consistent dividends. But where I grow my wealth are in my US portfolio. So in other words, the US market and the Singapore market, they are both good for different reasons. Now, having said that, if you look at the Singapore index, although you saw that after 10 years, there was like less than 1% return, but remember, not all the 30 stocks gave 1% return, right? In fact, there are some very good companies in the Singapore index that one could invest in that outperform the rest of the stocks. Let's take a very quick look at it. Now, again, there are 30 companies in the Straits Times Index. I can't put all 30 in one chart, it'd be too messy. So I divided it into 15 stocks in this chart and the other 15 in the second chart. So let's look at this first chart over here. Now this is a 10-year period, so you see the long-term performance, and we are comparing it to the STI. So the STI would be all 30 companies, the Straits Times Index. Again, you can see after 10 years, it's up only 0.2%. But within those 30 companies, you have stocks that gave at least some decent returns. For example, Venture Corp returned 185% over 10-year period. That roughly equates to about an 11 to 12% annualized return. Very close would be DBS Bank. So DBS also a pretty good performer over the long run. And next, pretty close as well, is Sembcorp Industries at 173% return in the last 10 years. And next would be Mapletree Logistics REIT. And others that also return more than 100%. By the way, 100% return in 10 years is about 7% a year, all right? Which is at least something, okay? So Ascendus REIT returned 135%, UOB 106%, OCBC 104%. So yeah, these are the ones that at least gave decent returns over the long run. And the ones over here, I would say not decent at all, right? So these are the first 15 components. Let's look at the next 15 over here. And again, we are comparing to the Straits Times Index, and we are only interested in stocks that return at least 100% over 10 years, because that equates to 7% return a year, which is, at least something, okay? So Yang Zhejiang is not too bad. In fact, 394%. The best performing stock in the Straits Times Index is Yang Zhejiang, right? And next, Mapletree Industrial REIT, 228%, which equates to about a 15% annual return. Not bad, pretty good. And Mapletree Pan Asia Commercial Trust, that returned 110% in the last 10 years. And the rest, again, not very decent, okay? So in summary, US market, great for capital gain, great for price appreciation. As a Singaporean, zero capital gains tax. But there is a 30% withholding tax on dividends. But again, US stocks dividend is so low that I don't even think about it, okay? Singapore market, capital gain pretty low, except for certain stocks I showed you. But dividend yield attractive with zero dividend tax, yeah? And like I said, I have a dividend portfolio where I get tax-free dividends from Singapore stocks, the top ones. But for capital gain, I focus on mainly the US markets using my 7-step value momentum investment criteria to select the top 1% of companies in the world. And that's how I'm able to get 20, 30. In fact, last year I got 45% return in 1 year in the US market. So I hope this has been educational. Hope you learn a lot, and I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.